Every single dollar you have worked for, saved, stressed over, and carefully set aside, the moment you die, it enters a system you were never told about. A system designed not to protect your wealth, but to redirect it. Quietly, legally, and in ways that most families only discover when it's already too late to change anything. You've been told that having money means your family is taken care of. But what nobody realizes is that having money without understanding this system means you've spent your entire life building something that the moment you're gone gets taken apart piece by piece. Stay with this, because what's coming in this video is going to change the way you think about every financial decision you make from this point forward. Most people assume death and money is a simple topic. Someone dies, their stuff goes to their family. Done. But that assumption is one of the most expensive misconceptions in the history of personal finance. The reality involves a system with multiple layers: government processes, financial institution, rules, tax codes, and legal mechanisms that most people have never been introduced to. And in this video, we're going to walk through all of it. We're going to talk about what probate actually is and why it's quietly one of the most destructive forces in middle-class wealth transfer. We're going to talk about the taxes that can hit an estate before a single dollar reaches your family, and the specific numbers that determine whether your family keeps the money or hands a significant portion of it over. We're going to talk about the financial accounts that automatically bypass everything and the ones that don't. And we're going to end somewhere most people never expect: the psychological reason why the majority of Americans, even wealthy ones, refuse to deal with any of this until it's already too late. Before we get there, there's one question I want you to hold in your mind throughout this entire video. If you died tomorrow, do you actually know where your money would go? Not where you hope it would go, where it would actually, legally, mechanically, go. Keep that question close. We'll come back to it. Let's start at the beginning. Not with law or finance, with a story. Because numbers alone don't show you what this system actually does to real people. In 2019, a woman in Ohio named Patricia lost her husband of 34 years. He had been the financial organizer of the household. He had a life insurance policy, a 401k, a small brokerage account, and a home they owned together. From the outside, it looked like a family that had done things right. Worked hard, saved consistently, built something. What happened after he died is something Patricia described in a local newspaper interview as like watching someone slowly dismantle the house we built, while I just stood there not knowing the rules. The life insurance paid out quickly, that part worked. But the brokerage account, which had no named beneficiary, got frozen immediately upon his death. It entered a court-supervised process that took 11 months to resolve. She paid an attorney. She paid court filing fees. She paid an accountant to help value the estate. By the time it was done, a portion of that account had been consumed by the process itself. Not by taxes, not by bad investments, by the system that was supposed to transfer the money. The house was another story. Because they owned it jointly, it transferred to her without going through the process. But in a different state, under different ownership rules, even that outcome could have been completely different. Patricia's situation isn't a horror story. It's actually fairly common, and what makes it so powerful is that her husband wasn't negligent. He wasn't reckless. He just never learned how the system worked. And when he died, that gap in knowledge had a direct financial cost. That's what we're dealing with here. Not theoretical risk. Real, documented, measurable losses, triggered simply by the absence of planning. So what is the system exactly? Let's start with the mechanism that most people have heard of, but almost none truly understand. Probate. Probate is the legal process by which a deceased person's estate is administered. When someone dies, if they own assets in their individual name without a designated beneficiary or co-owner, those assets don't automatically transfer to anyone. They enter a court-supervised queue. The court validates the will, if there is one, If there isn't a will, which is the case for roughly 67% of Americans according to a 2023 survey by Caring.com, the court applies the state's default rules, called interstate succession laws, to decide who gets what. Those laws don't care about your intentions, they care about legal relationships. And sometimes the outcome is exactly opposite to what the person would have wanted. The probate process is not fast. Nationally, the average simple probate case takes 6 to 9 months. Complex estates or cases with disputes can drag on for years, and the entire time the assets are locked, frozen. No one can sell them, access them, or use them. In some situations, that creates real financial hardship for the family members left behind. Beyond the time cost, there's the financial cost. Probate fees vary by state, but attorneys typically charge between 2% and 4% of the gross estate value. In California, the statutory fee structure can allow attorneys to collect around $23,000 on a $1 million estate, just for the attorney. Add in court costs, executor fees, appraisal fees, and accounting costs, and the total bill on a mid-size estate can easily reach 5% or more of the total value. On a $500,000 estate, that's $25,000 gone before your family sees a single dollar. And here's what most people don't realize. Probate is entirely public record. Every asset, every debt, every distribution, it all becomes a matter of public documentation. Anyone can look it up. That's not just a privacy concern. In some cases, it has led creditors and distant relatives to make claims against estates that would have otherwise gone uncontested. But probate is just one layer of the system. Let's go deeper. Because the next layer is the one people talk about even less, and it has the potential to hit hardest: estate taxes and inheritance taxes. There's a widespread belief in the United States that estate taxes are only a concern for the ultra-wealthy. And at the federal level, that's partially true. As of 2024, the federal estate tax exemption sits at $1,361 million per individual. That means estates below that threshold owe nothing in federal estate tax. For most people reading that number, federal estate tax feels irrelevant. But here's where the picture gets complicated. First, that exemption is temporary. The Tax Cuts and Jobs Act of 2017 doubled the exemption, but those provisions are scheduled to sunset at the end of 2025. If Congress doesn't act, the exemption drops back to approximately $7 million, adjusted for inflation, roughly half of where it is now. Millions of estates that currently sit below the threshold could suddenly find themselves exposed. Business owners, farmers, people who own real estate in high-cost markets, they're all watching this deadline with serious concern. Second, federal estate tax is only one piece of the picture. 12 states and the District of Columbia have their own state-level estate taxes. And here's what makes that significant. State exemptions are often dramatically lower than the federal threshold. Oregon and Massachusetts, for example, have estate tax exemptions of just $1 million. In those states, a home, a retirement account, and some savings can push a middle-class family's estate into taxable territory. The top state estate tax rates reach as high as 20% in Washington state. That's real money. That's generational wealth being redirected. And then there's inheritance tax, which is different from estate tax and often confused with it. Estate tax is paid by the estate before distribution. Inheritance tax is paid by the people who receive the money. 6 states currently have an inheritance tax: Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. The rates vary and depend on the relationship between the deceased and the beneficiary. In some states, close family members are exempt. In others, they're not, or they're only partially exempt. Maryland is the only state that has both an estate tax and an inheritance tax. If you live there and don't plan around it, your estate could face both. These aren't edge cases. These are numbers that affect families in those states every single day. And most of them find out about the exposure only after the fact. But this is where everything changes, because we've been talking about what happens to assets that go through official processes. But there's a whole other category of assets, and how they're treated at death is completely different, and in many ways far more important to understand. These are beneficiary designated accounts: your 401k, your IRA, your Roth IRA, your life insurance, your annuities. Assets in these accounts don't go through probate. They don't care about your will. They transfer directly to whoever is named as the beneficiary, period. That sounds simple. It is simple. But it hides a series of traps that cost American families billions of dollars every year. Trap 1. Outdated beneficiary designations. You set up your 401k at 28. You named your college girlfriend as beneficiary. You broke up at 30. You got married at 34. You had 2 kids. And now you're 51, and your 401k is the largest asset you own. And your ex-girlfriend is still listed as the beneficiary. This isn't a hypothetical. Courts have ruled consistently that beneficiary designations override wills. It doesn't matter what your will says. It doesn't matter what your spouse expected. Whoever is named on that form gets the money. The legal system isn't designed to fix emotional oversights. It's designed to follow instructions, and those instructions are the beneficiary form you filled out decades ago. Trap 2. Naming your estate as beneficiary. This happens more often than you'd think. Sometimes intentionally, sometimes by default when people leave the field blank. When your estate is the beneficiary of a retirement account, the account loses its ability to stretch distributions over time. All the tax advantages that come with inherited IRAs, the ability to take distributions over the beneficiary's lifetime, those go away. The money gets pulled into the estate, goes through probate, and the tax timeline compresses in ways that can dramatically increase the tax burden for your heirs. Trap 3. Not naming contingent beneficiaries. Your primary beneficiary dies before you. If you haven't named a contingent, a backup, the account defaults to the estate. Same problem, different trigger. These are not complicated fixes. Updating a beneficiary designation takes 15 minutes and a form. But most people either don't know to do it or don't think about it until it's too late. If you haven't looked at your beneficiary designations in the last 2 years, and if you've had any major life change since you last looked, pause this video right now, make a note, and check them this week. I want to say that again because it matters. Your beneficiary designations are likely the most powerful legal documents you have, more immediate than your will, more certain in their outcome, and most people last updated them when they were a completely different person. Now, let's talk about something that most financial content skips entirely, the digital estate. Because we live in an era where a significant portion of people's wealth, identity, and assets exist in digital form. And the law has barely caught up. Cryptocurrency is the most obvious example. If you hold Bitcoin, Ethereum, or any other digital asset, and you die without leaving behind your private keys or seed phrases in a secure, accessible format, that money is gone, not transferred, not probated, gone, permanently. The blockchain doesn't have a customer service department. There's no court order that can recover access to a wallet without the private key. Estimates vary, but researchers have suggested that somewhere between 3 and 4 million Bitcoin, representing hundreds of billions of dollars at recent valuations, may be permanently inaccessible due to lost keys, forgotten passwords, or the death of owners who never made arrangements. That's not a rounding error. That's one of the largest wealth destruction events in financial history, happening in slow motion, and almost no one is talking about it. Beyond crypto, think about online brokerage accounts, PayPal balances, business revenue coming into Stripe, royalties from digital products, domain names with real market value, monetized YouTube channels, subscription businesses. Many of these assets have no automatic transfer mechanism. Some platforms have terms of service that make accounts non-transferable by design. Others have no process for notifying the estate of a balance, even when one exists. The legal framework for digital estates is still being built. Only a handful of states have comprehensive laws giving executors the authority to access and manage. digital assets. The revised Uniform Fiduciary Access to Digital Assets Act has been adopted in many states, but not all. And even where it is adopted, execution is inconsistent. Your executor may have the legal authority, but face a tech company's compliance wall and months of back and forth that delays and complicates everything. The practical implication: if any meaningful portion of your net worth is digital, you need a specific, documented plan for how those assets are accessed and transferred. Not a vague note. A specific, documented plan. The system doesn't handle this automatically. You have to build the bridge yourself. And now we get to the part of this story that almost no one in the financial world wants to have publicly. Because what we've been describing, probate, estate taxes, outdated beneficiaries, digital asset loss, these aren't just legal or mechanical failures. They are symptoms of something deeper. They are symptoms of a massive psychological avoidance around the subject of death and money. Study after study has documented it. A 2022 report from the Nationwide Retirement Institute found that more than half of Americans say they haven't created an estate plan because they haven't thought about it, despite knowing they should. Not because they can't afford it, not because they don't have enough assets to justify it, because they haven't thought about it. The tool to think about their own death and what happens after it is so uncomfortable that they simply don't pick it up. Behavioral economists have a name for this: mortality salience. The awareness of our own death triggers anxiety that most people manage by avoiding the topic entirely. We don't plan around death. We avoid planning because planning requires us to look at death directly. Financial advisors report this pattern constantly. Clients who are highly disciplined investors, who model their retirement scenarios in detail, who rebalance portfolios quarterly, those same clients will go years without reviewing their wills, without updating their beneficiaries, without having the conversation with their spouse about what actually happens if one of them dies first. It's not laziness, it's psychology. And it's costing American families an estimated $300 billion in preventable estate losses every decade, according to aggregate analysis by estate planning researchers at the American Bar Association. Think about that number. $300 billion. That's not money taken by market crashes. Not money lost to fraud. Money lost because people couldn't make themselves sit down and think about what happens when they die. And the financial industry, with rare exceptions, doesn't push hard on this. Because there's no product to sell in estate planning the way there is in investment management. An estate attorney charges a flat fee to draft a will and a trust. A financial advisor earns ongoing management fees. The incentive structure doesn't align with getting people to confront the death conversation. So it doesn't get confronted until it has to be. So what does a well-designed estate actually look like? Let's walk through it, not as a checklist, but as a picture of what's actually possible when someone understands the system and builds intentionally around it. The foundation is a will. Not because a will avoids probate, it doesn't necessarily, but because a will expresses your intent. It names guardians for minor children. It clarifies who should serve as executor. It handles the assets that don't have other transfer mechanisms. Without a will, your state makes those decisions, and your state doesn't know your family. It doesn't know the estrangement, the substance abuse history, the adult child who's genuinely prepared to steward a legacy versus the one who isn't. A will gives you the voice. A revocable living trust takes it further. Assets held inside a trust bypass probate entirely. The trust continues to exist after your death, managed by a successor trustee you've named in advance. Distributions happen on your timeline, according to your rules, without court supervision. For many families, the cost of setting up a revocable living trust, typically between $1,500 and $3,000 for a basic setup with an attorney, is recovered many times over in avoided probate costs and preserved family relationships. Trusts also offer privacy. Unlike probate, which is public record, trust administration is private. Your family's business stays your family's business. Then there's the beneficiary audit. Every account with a beneficiary designation, life, insurance, 401k, IRA, Roth, annuity, needs to be reviewed. Primary and contingent beneficiaries both, cross-referenced against current family structure and current intent. Done at least every 2 to 3 years and after every major life event, marriage, divorce, death of a named beneficiary, birth of a child. This isn't complicated, it's just deliberate. For larger or more complex estates, additional tools come into play. Irrevocable trusts can move assets out of a taxable estate entirely, useful for estate tax planning and asset protection. A properly structured irrevocable life insurance trust, for example, can hold a life insurance policy in a way that keeps the death benefit out of the taxable estate, even when the total benefit would push the estate above exemption thresholds. Charitable tools like donor-advised funds or charitable remainder trusts allow wealthy families to reduce taxable estate values while directing money toward causes they care about. These aren't loopholes. They're legal structures that exist precisely for this purpose. The people who use them aren't doing anything that the tax code doesn't explicitly allow. They're just playing the game according to rules that most people never read. And the people who don't use them? Their estates pay the costs. Their families deal with the delays. Their legacy gets processed by a system that was never designed with their specific wishes in mind. There's one more element that almost never gets discussed in the context of estate planning, and it might be the most immediately actionable thing in this entire video. It's the letter of instruction, not a legal document, not filed with any court. Just a letter, written by you, addressed to the people you love, telling them exactly where everything is, how everything works, and what you want. Where your accounts are held and how to access them. Where your insurance policies are and who to call. Where your will and trust documents are stored. What your digital passwords and accounts look like, stored in a password manager, and how to access it. What your funeral preferences are. What your wishes are for specific items that may not be covered explicitly in the will. A letter of instruction doesn't replace legal documents. It complements them. It fills the gap between what the law requires and what a family actually needs in the first weeks after a death. When grief is overwhelming and decision-making is compromised, the people who leave this letter give their families an enormous gift. Not just money, not just assets, clarity. When everything is confusing and painful, clarity is invaluable. Most people never write it, not because it's hard, because it requires them to imagine themselves gone. And that imagination is the thing that stops almost everyone. Here's what I want you to sit with as we get close to the end. Everything we've talked about in this video, probate, estate taxes, outdated beneficiaries, digital assets, psychological avoidance, it's all connected by a single thread. The system that handles your money after you die was not designed with your family in mind. It was designed by states, by financial institutions, by tax code writers, each pursuing their own objective. The court system's objective is legal clarity. The tax code's objective is revenue collection. The bank's objective is liability management. None of those objectives is your family's financial well-being. None of them is your legacy. If you want those things protected, you have to build that protection yourself. Deliberately, proactively, before you need it. The people who do this, even imperfectly, even partially, leave their families in dramatically better positions than the people who don't. The difference isn't usually wealth. It's knowledge. It's the willingness to look at the uncomfortable thing directly and make decisions accordingly. And the reason this matters right now, in 2024 and 2025, is that the policy environment is genuinely in flux. The estate tax exemption sunset, the ongoing development of digital asset law, the post-COVID acceleration in asset accumulation for a large segment of middle-class Americans who now have more to lose than previous generations at the same age. The cost of doing nothing is rising. Every year you wait, the complexity of your estate likely increases. Every year you wait, the potential cost of an unplanned transfer grows. The time to build the system is not when you need it. The time is now, when you have the clarity and the capacity to do it right. If you started this video with the question of what would actually happen to your money if you died tomorrow, I want you to end with a more specific version of that question. Not just where would it go, but how long would it take to get there? How much would be lost in the process? Would the people I love know what to do and where to look? Would my digital assets survive my death or disappear with me? Those are the real questions. And the fact that most people can't answer them, not because they're unintelligent, not because they haven't worked hard, but because no one ever taught them this part of the financial system, is exactly why this conversation matters. You now know more about what happens to money after death than the majority of Americans. That knowledge is only useful if you act on it. Start with your beneficiary designations this week, not someday. Check every account. Update anything that's outdated. Then move to the will. Then the trust if your situation calls for it. Then the letter of instruction for the people you'd leave behind. Do it in stages if you have to, but do it. Because the greatest financial gift you can give the people you love isn't the money itself. It's the plan that makes sure the money actually reaches them. If this video made you think differently about your own financial picture, subscribe to FinTrove. Because this is exactly what we do here. No hype, no generic advice. Just the parts of personal finance that actually matter, and that almost no one else is willing to explain at this level. And if you want to go deeper on the specific legal tools we talked about today, trusts, beneficiary strategies, the digital estate, that video is next. Don't let this be the moment you almost changed how you think about your money. Let it be the moment you actually did.